Listen, don't move, because what I'm about to tell you is something 99% of crypto investors never hear, and the 1% who do end up positioning themselves years ahead of everyone else. There is a silent move happening right now behind the scenes of global finance, a move that directly involves XRP, and almost nobody is paying attention to it. But here's the shocking part. By the time people finally understand what's happening, the real opportunity will already be gone. And the investors who ignored the noise understood the data and paid attention to what the big players were doing, not what retail thought they were doing, will be the ones holding the winning ticket. XRP is not reacting to hype. It's reacting to something bigger, something deeper, something that almost feels hidden on purpose. And once you see the full picture, you'll understand why experts believe XRP's next major move won't come from retail FOMO, but from a liquidity shock that forces the entire market to wake up at the same time. So don't blink, don't skip, because if you miss even a few seconds of what I'm about to break down, you'll miss the exact reason why the next wave of smart money is quietly loading up on XRP while the rest of the market sleeps. Let's start with the obvious question. What does smart money know that retail doesn't? Why are institutional wallets steadily accumulating XRP even when social media is calling it boring, dead, or outdated? Why is the price range so tight? Almost unnaturally tight. And why does the liquidity map show positioning that doesn't match its current retail interest at all? When you zoom out and look at what's happening globally, a pattern appears, and that pattern leads straight to cross-border liquidity. One of the biggest financial bottlenecks in the world today is the slow and outdated system for transferring value between banks, especially across borders. And in research published by the Bank for International Settlements, cross-border settlement inefficiency remains one of the most expensive problems in global finance. That's not my opinion. That's direct from the BIS, the institution that coordinates global banking rules. Now, you might think, okay, but what does that have to do with XRP? Well, everything. One of the earliest goals of XRP was to become a bridge asset, something that can move value between currencies in seconds, without needing pre-funded accounts, without friction, and without massive fees. It's not a meme coin, it's not a hype coin, it's not designed to pump based on community noise. It's designed to solve a multi-trillion-dollar problem. And if you think that sounds like marketing hype, let me mention this. According to Ripple's official documentation and financial reports, more than 75% of RippleNet transactions in the past year used XRP as the bridge asset. That means institutions, banks, payment providers, and remittance companies are already using XRP behind the scenes, even if retail doesn't see it. But here's what gets interesting. The bigger players don't care about price action the way retail does. They don't view XRP as a quick pump. They view it as a settlement layer. And that's why the market structure looks completely different than typical retail-driven coins. When you look at the liquidity levels, the limit order clusters, and the compression patterns, you can see a setup that long-term investors love. Tight consolidation, low volatility, strong on-chain accumulation, and a decreasing supply on exchanges. Data from Sentiment and CryptoQuant shows XRP's exchange supply has been slowly trending down for months, meaning more tokens are being taken off exchanges and stored long-term. Retail isn't doing that. Institutions are. To understand where this is heading, you have to see what's happening with global payment corridors. Ripple has been expanding into regions where cross-border transfers are slow or expensive, including Latin America, the Middle East, and Southeast Asia. When Ripple partnered with SBI in Japan for remittance flows to Southeast Asia, the settlement times using XRP dropped from hours to seconds, and fees dropped by more than 50%. That's why SBI's CEO keeps publicly stating that XRP is positioned to become a global standard for remittances. Now imagine this at scale. Imagine not just remittances, but corporate settlements, banking liquidity, tokenized assets, and interbank transfers. Because here's the part most people don't know. The value of instant settlement becomes even more important once tokenized assets go mainstream. And this isn't a theoretical future prediction. This is already happening. BlackRock's CEO, Larry Fink, has repeatedly stated that tokenization is the future of finance. And according to a Boston Consulting Group report, tokenized assets could hit $16 trillion by 2030. Let's pause for a second. $16 trillion of value needing instant settlement rails. And which asset is already proven to do that? XRP, and it gets even deeper. Because as tokenized bonds, tokenized real estate, and tokenized commodities grow, settlement layers that are fast, cheap, and reliable become mandatory. XRP's structure is designed for exactly that. Meanwhile, retail looks at the price and thinks nothing is happening. But institutions look at settlement efficiency, liquidity depth, transaction reliability, and regulatory positioning. Speaking of regulation, we need to talk about one more thing. When XRP won its major legal clarity regarding programmatic sales, it became one of the very few large-cap crypto assets with a court-tested classification that matters more than people realize. In the world of institutional finance, uncertainty equals risk, and risk slows adoption. Clarity accelerates it, which is why you've quietly seen an increase in institutional products that include XRP exposure globally. Not hype, not retail FOMO, but serious positioning. And if you connect the dots between tokenization, cross-border settlements, liquidity corridors, and regulatory clarity, you see the full picture forming, a picture retail investors won't understand until after the move happens. And here's where the opportunity becomes extremely interesting. Historically, assets with strong fundamentals and long periods of consolidation tend to have explosive moves once liquidity breaks. Not small moves, large moves. The best example is what happened with Ethereum in its early years. Years of accumulation, low volatility, then a sudden supply shock as demand increased. Same with Solana after its long quiet period. Same with Cardano before its major run. XRP is in one of the longest compression phases in its price history. And long compression often leads to violent expansion. And when you combine that with increasing institutional accumulation, decreasing exchange supply, growing remittance volume, expanding corridors, regulatory clarity, and tokenization demand, the setup becomes impossible to ignore. Now let's talk psychology, because this is one of the most powerful parts of the entire equation. The average investor expects instant results. They want a pump in a week, a flip in a month, a hype spike tomorrow. But that's not how real wealth is built in crypto. The real money is made during the quiet phases, when the market is distracted, when the asset looks boring, when the price moves sideways, and when the smartest investors are accumulating quietly while everyone else chases noise. And that's exactly what's happening with XRP. Retail has moved on to hype cycles, meme coins, trends that burn out quickly, but smart money has stayed laser-focused on assets tied to real-world usage, assets tied to infrastructure, assets tied to future financial rails. And if you study the decisions made by financial institutions, from remittance giants like Tranglo to regional banks in Asia and Europe, the adoption of XRP is not decreasing. It's increasing. Here's another detail most people don't track. The global on-demand liquidity volume. Ripple reports that ODL volume grew massively year over year, even during regulatory battles, even during market downturns. That means utility demand continued rising while speculative demand dropped. This is the kind of divergence long-term investors love. And let's address the big elephant in the room: price suppression. Many analysts believe large players intentionally keep certain assets stable during infrastructure expansion. Why? Because volatility is bad for settlement services. Once corridors are fully built, once more banking partners integrate, and once tokenization demand increases, the liquidity requirements skyrocket. And that's when stable assets experience a supply shock. Which brings us to the most important part. What triggers the move? What forces XRP to break its long range? What creates the sudden expansion? There are three major catalysts. First, tokenization at scale. Once major institutions begin issuing tokenized securities, tokenized funds, and tokenized currencies on a wide scale, the settlement bridges must be fast and efficient. XRP is one of the few assets proven to settle value at that speed. Second, regulatory clarity around stablecoins and banking crypto usage. When stablecoin regulations become formalized, banks will need settlement layers for currency conversion. XRP becomes a natural fit. Third, liquidity corridors expanding into high-volume regions like India, Africa, and the Middle East. These corridors generate real transactional demand, not hype-based trading. And real demand forces price movement. Now imagine all three catalysts hitting within the same cycle. That's what experts believe could create the explosive move everyone is waiting for. And the crazy part is, most people won't notice it until it's already halfway done. So here's the truth. You don't need speculation. You don't need hype. You don't need unrealistic price targets. What you need is a logical understanding of how global finance works, and why assets like XRP are positioned the way they are. The investors who win big in crypto aren't the ones who predict perfect bottoms or perfect tops. They're the ones who stay positioned when the market is quiet, when the opportunity looks boring, when the price stays flat for longer than expected, and when the data says accumulation is happening under the surface. That is exactly what is happening with XRP right now. Quiet accumulation, expanding utility, increasing adoption, rising settlement volume, decreasing exchange supply, and long-term structural setups pointing toward a major move. And the reason people miss out is simple. They get bored and move on right before the explosion. So the question now becomes simple. Are you going to let boredom distract you? Or are you going to see the data for what it really is? A setup that rarely appears in the crypto market. A setup that replaces hype with fundamentals. A setup that smart money loves and retail always overlooks. Because when this move finally happens, it won't be slow. It won't be small, and it won't be kind to those who hesitated. The liquidity shock will be fast, aggressive, and unavoidable. And the investors who understood the signs early will be the ones who benefit the most. So as the world sleeps on XRP, smart money keeps moving quietly. And the next major shift in global finance gets closer every single day.